Price fluctuations in the stock markets are often puzzling and difficult to predict, but if you dig a little deeper into the stock market's data, you will find a few factors that contribute to its price changes. So, if you have a firm grasp of these considerations, you will be in a better position to make calculated risks into your stock trading. So, the question is, what factors influence the stock market prices? Well, let's find out. So the first factor is actually supply and demand. Supply and demand is a major factor that affects stock prices. So stock prices tend to fluctuate when supply and demand are out of sync. So the rule of thumb is that prices go up when demand exceeds supply and down when supply exceeds demand. For example, if there is high demand for Apple shares but insufficient supply, the price will rise. Conversely, if there are plenty of Apple shares available but weak demand, the price will fall. The second factor is market sentiment. In addition to economic fundamentals, human psychology plays a role in determining stock market values. So, emotions actually play a role in decision making, and this is true in trading as well if you do not know. The stock market is susceptible to the influence of rumors. Concerned about losing money, investors may avoid investing in a company or unload their shares if rumors circulate that it will report lower profits than expected. Similarly, if investors learn that the company expects huge profits, they may become more confident in the stock and purchase more shares in the expectation that the stock price will continue rising. Another time when market sentiment has an effect on stock prices is when there are major geopolitical issues. A trader who follows current events could, for example, predict a drop in profits if a boycott were to occur against a particular company and its products. So the stock price may fall if shareholders decide to sell their shares because of this. The last one is actually company foundational concepts. So as I said earlier on, fundamentals such as supply and demand and as well as market sentiment play a role in determining the price of a company stock. So stock prices are affected by a trader's expectations and analysis of changes happening at a company in response to the company's performance. For instance, if there's a change in the board of directors at a company, traders may investigate and track the record of the new board to determine if the company will fare better under the new leadership. So investors might actually try to stay away from a company stock if they believe it will lose money under the new management. So to prevent future substantial losses, they may even consider selling their stock at a slightly reduced price. So if investors actually have a similar opinion, supply exceeds demand and the stock price of the company falls. Okay? And finally, the financial markets may actually react positively to a company's rebranding or other major changes if they anticipate future gains. As a result, they could put more money into buying shares of the company in the hope that the price will continue to rise, thereby increasing their profits. So, when it comes to traders who put their trust in research, analysis, and who base their observation on stock market reports may be able to more accurately predict the stock market, and the wiki market reports and in-depth articles on fundamental analysis can actually help you gauge the safety of your investments. So it is important to remember that we don't need to actually own an asset to trade it. For example, if you are trading from brokers such as Deriv, okay, so you can potentially profit from either price increases or decreases. So now that you have understood what goes into determining the stock prices, it's time for you to try and trade. So this is it about this video. If you learned something from it, give it a like. For more videos like this, go on and subscribe. Bye for now.